Anyway, so let us start with uh, this session, which is on commodity and currency trading. Now, let me tell you one thing in advance that today we'll be looking at the basics. Okay, basics. What are the rules? The rules are slightly different from how you trade in say stock futures options or whatever. Now, whenever we are trading commodities or currencies, basically you can only buy futures, buy or sell, of course, and options. You cannot buy or sell commodity or currency in cash directly using the exchanges. Okay, you can go to market and buy whatever food you want. That is a commodity. That's a different thing. I'm not talking of that. I'm talking of trading it in the markets. So let us first start with commodity and then we will go for currency. Okay, no particular reason as such. Um, Fine, one we have to start first. So we start with commodity first. Now, how can we trade commodities? Lot of misconceptions are there, and from whatever doubts my students keep asking, um, based on that, I've made this session, I've kept this session so that all the doubts will be solved. And of course, those who are not registered students with me, for them, if they want, they also should be benefited. So I gave it to them also. Okay. So let us start with this trading commodities. First of all, what are commodities? Okay. When we talk of commodities are essentials. Food grains, agriculture product, metal, energy, they fall under commodities. Actually, if you see the assets fall under four main categories. Which four? One is cash. When you say cash, it may be cash as in currency notes in your hand. Okay. Other is bonds. Whatever in India commonly called as Vikas Patra, Kisan Vikas Patra. These are a type of bonds. It's a bond. Bond is a loan. You are giving loan to government, essentially, and government will be paying you interest on it. Okay. Bonds. Third is the stocks. All of us know what are stocks, right? Shares. And fourth is commodities. Now, when you talk of a house, is house a commodity? Yes, house is a commodity. But you cannot trade it on the exchange. Okay, so all commodities are not traded on the exchange. But most commonly traded commodities are food grains. We are going to see which can be traded, which cannot be traded, etc. Then some of the food products, though I have listed here only food grains, oil, edible oils, some of them are listed on commodity exchange. Okay. Then even animal feed, sometimes like cake, oil cake. What is oil cake? After extracting oil from oil seeds, whatever is left is called oil cake. Okay. Then there are some other agricultural products like guar gum. Guar. The same beans that we eat. Gum is extracted from it. That is traded as an essential agricultural product. Okay. In fact, guar was a very cheap vegetable once. But then it was found that if this guar is used while drilling holes in the soil for oil exploration and all, okay, it increases the life of the drill. Actually, what I said, truckloads of guar gets used over there, and then it became a very essential and expensive commodity. Metals. Metals fall under two main categories: industrial metals, like steel, aluminium, copper, nickel, zinc, lead, and bullion is essentially gold and okay. Other bullion metals were once in our markets, but liquidity was very low. Nobody was trading like platinum and all. Now it's not traded anymore. Energy, all right, energy sources. So they fall under commodities, all of them. Now, when we are talking of trading them, How are these traded? They are traded on two exchanges in India, largest exchanges I'm talking of. I'm not talking of spot markets where you can buy it directly. I'm talking of futures options. So one is MCX, Multi Commodity Exchange, and the other is NCDEX, National Commodities and Derivative Exchange. Now, I know MCX will be known to most of you. NCDEX is not that common, but basically NCDEX trades agricultural commodities. Okay, some commodities are overlapping, but only limited. Majority of them are well segregated. What will be traded on MCX? What will be traded on NCD? So whenever we are talking of trading these, as I said earlier, you can buy their futures, and in some cases, very few cases actually, you can also trade in. We are going to see both futures, options. What are the rules for them? Because rules are different, as I said. Futures also, most of the rules are same, but options there is quite some difference. Okay. So, what about other countries? Remember, every country has commodity exchange. In fact, a commodity market in India is in a very, what I'll say, primitive stage. Very few commodities are traded in Indian markets, and the liquidity is fairly low for commodity markets in India. Comparatively, if you see other markets like CBOE, Chicago Board of Exchange, or even other foreign markets, liquidity is quite good. Initially, it is presumed that the first commodity to get traded was coffee. Okay. Now, some argue with it. They say that rice exchange is in existence in Japan for centuries. True or false, or official status and all, let us not fall into it. But coffee and rice, there is a competition. Majority say coffee was the first. Some argue saying rice was the first commodity to start getting traded. Different exchanges, different countries, exact dates are doubtful. But these were the initial traded commodities in international markets. Now, these commodities are traded to very large extent. At the same time, can you buy or sell in it? The simple answer is directly you cannot buy or sell in any foreign commodity exchange market. You require a trading account with that exchange. Okay, and directly you cannot pay in rupees and all. So a lot of complications. So let us not fall into that. Let us focus our studies on Indian markets. At the same time, remember there are certain rules which you should know well beforehand. Other way around, you may find you are making good money and all at a sudden your money is gone in commodity markets. You have to be careful about that. Okay. Now, what are the types of contracts? These are delivery-based contracts primarily, except a few. Okay. Few contracts are cash settled, majority are delivery settled. Delivery settled means you have to take delivery of that material, of that commodity. Okay. Cash settled, only the money changes hands, like in Nifty or Bank Nifty. You don't have to take delivery. The difference is, if you are buying, let us say you have bought Reliance futures. Reliance goes up. So 250 is the lot size. You have to take delivery. You have to keep sufficient money in your account, which is substantial for 250 shares of Reliance. And at the expiry, you will be getting Reliance at the price of your buying. Okay, so you will have to take delivery of it. But delivery means what? It remains still in demat form only. You don't get Reliance shares in your hand. It remains in your account directly, right? Money will go from your account, shares will be transferred to your account. The problem with commodities is it is physical delivery, means you have to take that. Okay. Suppose if you say I am buying, say, one lot of a commodity like dhania seeds. What you have to do is you have to take those dhania seeds. They don't remain in your demat account. Okay, you have to take them, carry them. Other way around, you can store them in your in government warehouses. We'll come to that later on. But you have to actually take the delivery, and then you have to sell it again or whatever, consume it or whatever. Okay, so that is the basic difference. So these are delivery-based contracts. So you have to go to the government approved warehouse, wherever it is located at a designated place, and take delivery of the goods. Let us say, for example, gold. You want delivery of gold. You have bought a lot future of gold, which is delivery set. Then Ahmedabad warehouse or Mumbai warehouse, you have to go there and take your 1 kilo of gold in your hand. Understood? If you don't want to take it out, no, it is whoever is the seller gives it into deposits in the warehouse. Warehouse will check the purity. It will see that it is fitting the norms and keep that block of 1 kilo of gold aside. When the contract is expired, you have gone there. What you have to do, you have to check the purity and take it. If you trust them, it's okay. If you don't trust them, you want to check, they will check it for you. And you will be bearing the cost of checking the purity. And then you have to take that gold out. If you don't want to take that gold out, then simple thing, you have to pay the amount and keep it in the same warehouse. They'll give you a receipt that 1 kilo of your gold is deposited there. You have to pay the warehouse rent also till you don't actually sell it to somebody else. Okay. So that is giving or taking delivery of commodity. Now, sometimes this can have problems. If you are not present at the warehouse, then what? Then the demurrage and all penalties, they are charged to you. Okay. In US, as I told you already, many commodities are traded. Now, one of the commodities is cattle, cows. Okay, cattle. Lot is 200 animals. All specification, how many cows, how many bulls, everything is specified. But cattle. So it so happened one of the traders used to trade in one lot of cattle. So he used to buy futures, one lot. Near the expiry, he would square off for this month and buy one lot future for the next month. This is called rolling over the long position. Okay. It was not computer-based trading over there at that time when I'm telling you the story. Of course, even now, US markets, very few are fully computerized. The first market to get 100% computerized in the world was National Stock Exchange India, and second was Bombay Stock Exchange India. And these two are fully computerized. Other very few exchanges are 100%. They are still shouting with the certificates. Okay, as we see in the movies. The New York Stock Exchange is not 100% computerized. Almost it is done, but still not 100%. Some shares are still, certificates are traded. Anyway, so let us come down to commodities back. So what happened was this person used to roll over one lot of cattle futures. So he just called his broker saying, roll over long position of cattle futures. What happened was the operator was punching the order. He made a mistake. Instead of selling for this month and buying for the next month, he bought for this month and shorted for the next month, future contract. But the time of expiry, this person was told, you are 2 lots long on cattle, so take your 400 cows from Texas. Texas was the place of settlement, the ranch. He called his broker saying that I'll ask to roll over. The records were checked. Whenever you call a broker, everything is recorded and kept, right? Till the settlement doesn't take place. The records were checked and it was found that yes, this person had asked to roll over the long futures. And the person who punched the order made the mistake. So that clerk who made the mistake, he was sent to Texas, take care of 400 cows, animals, keep them clean. Next month, settlement, give the delivery and come back. This kind of problems are there in physical delivery contracts. You have to be ready with the infrastructure if you are taking delivery. Okay. So in India, though we don't trade cows, other materials are there where physical delivery is intended. And if you allow that contract to expire, even by mistake, you have to honor it. Okay. At the same time, position size has limits. Because, commodities, how many commodities are there? Suppose a certain quantity of, let us say, turmeric is produced per year. And you short more than that. Now, how you are going to give delivery or take delivery for that matter? You cannot, right? So there is a limitation on how much position a person can take. And for the brokers also, the limits are there. That per broker, maximum these many kilos are, or these many lots are allowed. Kilos, everything may not be in kilos. These many lots are allowed. So automatically, the overall size remains under control. More than that, you cannot open it. Suppose 5,000 lots is the limit to your broker, and you want to place an order, and already 5,000 lots are open under that broker, you cannot take it. Now, somebody else may have open positions available. That everything is apart. But directly, you cannot do this because there is a broker-wise limit also. There is person-wise limit also. How many lots maximum one person can take? Okay, that limit is also in Nifty. If you don't know about it, there is a limit. You cannot give order for buying or selling 100 lots easily. Okay. Through multiple accounts you can do it, but not through one account. Now let us see what kind of contracts are there. Okay. Let us start with turmeric as an example. Now turmeric is traded on NCDEX. It is not traded on MCX. Lot size is 5 tons. But it doesn't come as the powdered turmeric. It comes as the turmeric stem, turmeric fingers they are called. Now, when you talk of 5 tons of turmeric, okay, everything is specified. What quality turmeric, how much moisture is permitted in it. Okay, how long should be the fingers? If the fingers are less than 3 centimeters long, how much maximum percentage is allowed? So they say, fine, whatever turmeric heap of it you have brought here, that to the seller they will say, we will first check how many are foreign bodies in it, which is not turmeric but something else. How many are short fingers? How many are fingers of more than 3 centimeters? So short fingers up to 15% are allowed. More than that is not allowed. Say, for example, that is specified by a exchange. So what quality? If it is substandard quality, then the seller who has brought the turmeric, exchange may simply reject it, saying it's not of proper quality. Okay. Now, whoever is the buyer, he goes there with his contract matures, he has to take delivery of that turmeric. It is approved by the government warehouse. Again, either he can immediately take it out or he can store it. But of course, when he has stored, if it gets damaged, it is his responsibility, not of the warehouse. Warehouse has limited responsibility in that. So, agricultural commodity, majority of the warehouses insist that you take it out of the warehouse. We don't have sufficient place to store. Other way around, you have to sign a bond with them, which indemnifies them that if this product gets damaged, they are not responsible. Okay. So that is the thing. Anyway, so now quotes of turmeric are given per quintal. Now see, size is 5 tons, but quintal is what? 100 kilos, right? So turmeric is 5,000 rupees, suppose, just taking a arbitrary figure, 5,000 rupees a quintal. 5,000 into, say, 5 tons, that is 50 quintals. That is the lot value. Okay. Expiry is on 20th of every month. If 20th is a holiday, the previous working day is the expiry. And delivery places are Nizamabad, Sangli, Erode, and Basra. Now, these 4 places are for delivery. So you will have to go there, one of the places which is already specified with your contract. With your brokers are usually a particular locality, particular warehouse, which decided already. So if you are buying in Mumbai or Pune or Maharashtra, anywhere, or near Western India, the places you have to go to Nizamabad. If it is South India, you have to go to Erode. If it is North India, you have to go to Western India is Sangli, North India is Nizamabad, South is Erode. Likewise, places are decided. You have to take your material there to sell, and you have to take delivery from there if you're a buyer. Okay. You have to be there and take delivery. So this is actually good, mainly for those who are either farmers or those who are large level consumers. For them, it's convenient. For us, small traders, you don't have to take delivery, but you have to sell that contract if you have bought it, or buy it back, you have sold it. Okay, that you can do just like futures options. The problem is liquidity is fairly low. That's the problem. But what you can trade on NCDEX, let us see that first. There are different categories. First category is cereals and pulses. Under this, you can trade chana, bajra, barley, okay, moong, wheat, maize, paddy, rice, right? This you can trade in it. The problem is, especially with commodities like wheat. Many times it happens that this market, futures market, is used for speculation and for artificial rise of prices. So many times in history it has happened. Grains like wheat, government bans it from commodity trading periodically in between if prices are going too high or something. That can happen sometimes. Then only existing contracts are allowed to expire. No new contracts are permitted. Okay. But rarely that happens. Not every time, but sometimes it can happen. It has happened in the past. Then fibers. Fibers come under two categories. One is kapas and other is 29 cotton. This quality is different. Basically, it's cotton only. Quality is different. Spices. Turmeric, coriander, and jeera. Commonly traded spices. Metals. Long steel. That is under NCDEX. Okay. Oil and oil seeds like castor seeds, castor oil. Okay. Cotton seed oil cake. Oil cake, I told you earlier. They remove oil and whatever is left out. It is very good animal feed, or sometimes it is used in fertilizers, improving texture of soil, etc. So oil cake that is used, soya oil, mustard oil, crude palm oil, etc. Quite a few. Now, more will be added in future. Don't worry about it. This will keep on expanding. At the same time, all this you can trade on NCDEX. Then guar seed, guar gum, gur, and coffee. These are also traded on NCDEX. All right. So basically, when we talk of NCDEX market, these all things are bought, sold in futures. The problem is extremely low liquidity of contracts. Some contracts, you will find in a day, hardly less than 10 contracts are traded. Now, actually, commodity markets work from 9 in the morning to 11:30 at night. Closing time sometimes increased also depending on European markets, their daylight saving time and all. But in that time, that is 9 in the morning to almost 11:30, 12 at night, 15 hours, 2, 3, 5 contracts are traded. Some of these commodities have that low liquidity. Okay, so liquidity is extremely low. Sorry. So that is a problem. Options are almost non-existent on NCDEX. What can be traded on MCX? Let us see that. Bullion, gold and silver. Now, gold and silver come under different categories also, quantity-wise. Then comes metals, industrial metals, aluminium, copper, lead, nickel, and zinc. Energy, crude oil, natural gas. And agricultural commodities, not as many as in NCDEX, but some are traded here. They are basically cotton, crude oil, kapas, mentha oil, and rubber. Okay. Two MCX contracts have liquidity. The two types of contracts are on MCX, futures and options. Options are not for all commodities. Only for some commodities, options are there. And lead, cotton, rubber, nickel, they have poor liquidity. Gold, silver, then the crude oil, natural gas, they usually have good liquidity. Okay. If you see, when I say poor liquidity, as I said, less than 100 lots per day. Aluminium, copper, zinc, they have medium liquidity. Few thousand lots are traded every day. Futures of gold, silver, crude oil, natural gas, they have more than 10,000 lots traded every day and they are convenient for trading. Again, when I say gold or silver, there are different sizes available in it. I'll explain it to you in a little while. But all these, so personally, if you ask me, sir, which contracts do you trade? Now, I'm not a basically commodity trader, but sometimes I do take trades in commodities. My favorites are gold mini. For options, gold mini options are giving recently introduced, but good money I get in that. Silver mini, silver micro, they are good contracts. What are these? We'll see later on. Crude oil, the only problem is, lot size is 100 barrels. Earlier, there was a crude oil mini contract with 10 barrels, which I found convenient because liquidity was much more in it and margins required were low. Now, crude oil, 100 barrels, rarely I trade it, even natural gas. Aluminium, copper, zinc, sometimes I do trade. I prefer to stay away from lead and nickel. Rubber, cotton, I have never traded, never. Because of low liquidity, nothing else. Okay. So gold and silver have smaller size contracts available. Others, the sizes are standard. Two websites for NCDEX, it is NCDEX, directly type NCDEX, you will reach there, ncdx.com, and mcxindia.com. Okay, for MCX, it is mcxindia.com. When you go to these sites, you will find out the details and all. Let us just go to that site and see that more clearly. Okay, so this is NCDEX website. Okay, you can see products. When you click on products, you will find all products which are available. Then, if you go to options, it will give you all the options that are available. But honestly, to tell you, the liquidity is extremely poor for options. Most of them. Some are having liquidity, but very few. Now, when you click on the product, any one product, you will find what are the contract specifications. The refined soya oil, if I'm clicking on. Slow. Fine. So this gives you refined soya oil, all the details. You can download the futures brochure. It is not in options. Then it will give you all the information as to what are the contracts available. What happened to MCX? Anyway, something wrong with MCX, not loaded. Okay. Products, same way. And if I go for gold, it will give me products for gold, futures and options. Okay. All overview is there. Futures, contract specifications, you will get all contracts over here. Now, currently it is August 22 contract onwards. Click on it. You can download it, PDF file. You will get the specifications of gold contracts. From February 23, they already said the contracts are going to change. You can download that, see what is going to be the change from February 23. Okay. How much margin is required, how much position you can take, everything is specified in these PDF files. So all the details you will get, what expiry, everything. Okay. Now, whenever we are talking of these two, NCDEX or MCX, as I said already, MCX is having better liquidity for most of the contracts, but of course, very few are overlapping. So whatever has to be traded in NCDEX, we'll have to go for NCDEX. Personally, I don't trade. I have not taken a single trade in NCDEX. Only MCX. Now, gold. What contracts are there? Let us see that. First of all, future contracts in gold. Now, gold comes as gold. whatever name is used gold, it is 1 kilo of gold. Okay. Price is quoted for 10 grams. So if it is 50,000, 1 kilo of gold will be 50 lakhs, worth 50 lakhs. How much margin is taken? Typically, the margin is 6% to 8%. Somewhere in between is the margin required. Okay. Now, 6% of 50 lakhs, 1 kilo gold comes out to be 3 lakhs. All right. Plus some other charges here, there. So around 3 lakhs to 3.5 lakhs will be the margin required for 1 kilo of gold. All right. If you talk of, say, 8%, then it will go 4 lakhs plus. Usually 6 to 8%. 6% is standard. Okay. Sometimes it is increased if there is a lot of volatility in gold, then the margin is increased by the exchange. Second comes gold mini, 100 grams of gold. This was not there originally, but I think a couple of years back it was introduced, maybe a little longer. And then even the options are introduced for this from this January, I think, January, February. Options were introduced. And now moderate liquidity is there. A few hundred lots are traded in at the money options. Out of the money doesn't have much liquidity in options. Out of the money or in the money. Then comes gold guinea. Gold guinea is 8 grams of gold. Only futures are there, not options. Gold as well as gold mini have options also. Gold guinea doesn't have options in it. 8 grams of gold. Then there is gold petal, 1 gram. This is a compulsory delivery based contract. All right. So that these are the differences. Again, the rules remain same. You have to go to the warehouse and take the delivery if you want delivery. Other way around, square off before the expiry. Now, silver. Silver is another commonly traded bullion. What is called silver is 30 kilograms of silver and price is quoted for 1 kilo. Okay. So, suppose silver price is 60,000. That means the lot is 60,000 into 30, 18 lakhs. Okay. Then it's silver mini, which is 5 kilograms. And third is silver micro, which is 1 kilogram. Very convenient, highly liquid, silver micro. Others are not that liquid. Actually, sizes are big, margins required are more. And instead of buying 5 lots, 5 kilo in one lot, it's better to buy 5 lots of 1 kilo. Easier, you can even partially book profit or whatever. So silver micro has very good liquidity relatively. But again, options are there which are mainly for silver and silver mini, but no liquidity, not much liquidity. Now, option contracts, currently the options are available in copper, crude oil, gold, gold mini, natural gas, nickel, silver, silver mini, and zinc. Silver micro, there is no contract, and gold also. Gold guinea doesn't have the contract. Gold and gold mini have, gold petrol doesn't have an option contract. But majority don't have liquidity at all. The most liquid are gold, gold mini, then crude oil. Crude oil is there, yeah. Crude oil, they are liquid. Quite large number of contracts are traded in a day. Okay, relatively. Comparatively, others don't have much liquidity. Advantage is, you can buy a full lot of commodity option for a really small premium. Now, as I told you, say gold price is quoted for 10 grams. Suppose gold is near 50,000 and you want to buy a, say, gold mini contract, which is for 100 grams. You will find most of the times the price is something like 300 to 400 rupees. Now, this 300 to 400 is for 10 grams, but your lot is 100 grams. So, multiplied by 10, 3,000 to 4,000 investment. And you can buy a call or buy a put and you are controlling 100 grams of gold. So, when gold is really on a move, gold mini becomes a very effective contract to buy, okay, or to sell. And just a small risk, 3,000 to 4,000 can give you good money. Just before Diwali, I bought one lot of gold 50,000 call. My buying price was something like 340. which means my investment was 3,500. Okay. And I sold it for 15. Liquidity is low and you have to get out in time. You have to keep studying the charts. Then it becomes a problematic thing. Two things. Number one, market is open for too long. Okay, up to 11:30 at night. You have to keep a watch or keep proper stop losses or whatever. And second problem is overnight, if gold falls in international markets, next day directly you will get a cap down. So instead of buying futures, I would say buying calls is a better option, buying or selling. So buying instead of buying future, buy call, or instead of selling future, buy put. The liquidity is there. That becomes a better option because your risk remains under control. Okay. So multiplying your money in commodity options is really easily possible. If you're doing it properly, then yes. The disadvantage here is, if I buy one lot Nifty on call and sell another out of the money Nifty call, margins are sufficiently decreased because I'm having a hedge position. MCX is not giving you that. And that is why you have to pay as much margin as a shorting one lot for future, even if you are selling a hedged option. Margins required are more. Now, how is the settlement? Settlement cycle is to be understood. Some commodities are cash settled, where you don't have to pay any, take any delivery, like natural gas, crude oil, okay, or even for gold and cash settle is possible. But some are converted into futures. All right. In options, they get converted into futures only. What do we mean by they get converted into future? Suppose if a contract is expiring on a particular day, futures expiry will be after that. Take October, say November 4th is suppose gold expiring. On 26th or 27th of October, all the options, whichever are in the money, will get converted to futures. Okay, understood. So suppose I am having 50,000 call option of gold, which is for 4th November. And 27th October is the date of conversion of option to futures. Then on 27th October at the market close, my one lot option 50,000, if gold is above 50,000, I have 50,000 call, gold is above 50,000. Next day morning, I will find in my account there is no 50,000 option, but gold futures bought at 50,000. And then I have to treat it as futures for next 4-5 days till expiry. At the expiry, if it is delivery based, I have to go and take delivery. The problem starts if it is out of the money. If it is in the money, it is getting converted to future. If it is out of the money, its value becomes zero. It is considered worthless. Even if gold closes at 49,990, my 50,000 call becomes zero next morning. Next morning is at a time of closing that day. It becomes zero directly. Okay, so when you were so close, actually, I'll be happy it is having good value, but then it will suddenly become zero. So that is the problem. It gets converted to future. And even when it is getting converted to future, and actually, future requires more margin than buying the option. So that much margin you have to keep in your account. Other way around, again, it will become zero. All right. So these are the problems with option contracts. You have to sell them better way than getting converted to future. Now, if you say how many contracts are there, I'm talking of options here. Copper and silver, less than 10 lots per day is the volume. All right. Intermittently, in between, it goes to 1,000, but very rarely. Usually, it is less than 10 lots per day. So some news is there, then it increases and again falls. 10 to 100 lots are usually gold. All right. Now, when I say in between thousands, this means Silver 60,000 will have liquidity. 61,000 will have liquidity. But in between that, suppose you have 60,400, the liquidity is less than 10 lots per day for option. If you go for round figures, thousands, then silver has 10 to 100 lots in a day. 60,000, 61,000, 62,000 calls or puts. They will have more liquidity. Gold and natural gas, in between the figures, thousands, gold will have low liquidity. 50,000 gold will have liquidity, 51,000 gold will have liquidity, 50,600 will not have. Natural gas, of course, natural gas is not in thousands, in hundreds, but again, 400 will have liquidity, 420 will not have the liquidity. 10 to 100 lots will be taken. Gold ending with 1,000, those contracts up to 100 to 1,000 lots per day are traded. Natural gas also round figures, they are traded. And gold mini in between thousands also have up to 800, 900 lots every day. More than 10,000 lots you will find in crude oil and you will find in gold mini ending with round figures, thousands. Okay, so they are very highly liquid. So options, if I want to trade, I can trade crude oil or I can trade gold mini options. They are very highly liquid. Buying, selling is not problematic. But if you are taking copper or if you are trading silver, very few lots, copper 5 lots, 6 lots are traded one day. It's very less. I would say stay away from. Even at the money contract, out of the money is out of question. Okay. So which are the best options to trade? Best options are crude oil and gold mini. As I said, gold mini has good liquidity. At the same time, 4,000, 5,000 max is the investment. So you can easily trade it. Whichever is the day of expiry of that option, it is going to get converted into future. If you want, you can just square it off. Okay, other way around, keep sufficient margin ready, so it will get easily converted into futures. So what are the pros and cons in this? Movement is often strong. Very fast it moves. You have to be alert. You have to keep modifying your stop accordingly if it is going in your favor. Because it will suddenly sharply go up and sharply come down. You have to be alert. Liquidity is usually not a problem, especially with futures. Futures are very highly liquid for both these. Okay. Crude oil, international settlement is a problem. Now, futures are cash settled in both of them. Crude oil as well as natural gas. So nobody is going to tell you, take your 100 barrels of crude oil. Okay, no. If you bought crude oil, let us say, for example, at 7,000 and you sold it at 7,200, or even if the expiry is at 7,200, you did not sell, but it expires 7,200. 200 rupees multiplied by the lot size, 100 barrels. Price is quoted per barrel. So that is 20,000 is your profit. Okay. So cash set directly. The problem is overnight international movement. I remember I think couple of years ago, crude oil went to negative price. Now, never I had seen a commodity going to minus. You know, COVID was at the peak, and no vehicles were on roads. Nobody was buying crude oil, and crude oil price went to negative. Means we are going to pay you if you take crude oil from us. Okay, but after that, next day it opened at $15 something, and then it started running till it reached 100 directly. So that is a different issue. Just a moment. So overnight international movement can be huge. Sometimes somebody takes a decision. Some say Saudi says we are going to cut the production, or US says something, and next day morning we get a sudden gap up or gap down. So both these are largely affected by international policies, crude oil as well as natural gas. Okay. As I said, options are converted into futures. Now for crude oil and natural gas is 2 days before the expiry for 2 working days. For gold mini, it is 5 working days before the expiry. The option get converted into futures. So you have to make sufficient margin available if you are buyer or writer of that option, because your position will be converted to futures. And if you don't have sufficient margin, you can be a loser. Penalty will be there. In some cases, it's penalty. In some cases, even if your contract is in the money, it is just considered worthless because you did not pay for it. Okay, so if you don't want to really allow it to get converted to future, close your position before the scheduled date. Other way around, you can have penalties if margin is insufficient. And remember, margin suddenly increases. As we said, gold mini, even if you say 100 grams of gold, right? Now, considering 50,000 to be the price of 10 grams gold, approximately, 100 gram becomes 5 lakhs. Now, futures will require that 6%, 8% margin. So something like 30,000, 40,000 margin you'll require over there. Don't have that much margin ready on that day. You are in trouble. Okay. Now, gold and gold mini contracts, same, but usually international price movements are not that huge. Crude and oil can have really big movements sometimes. Like you must have seen right now, just this week, price of crude, natural gas in Europe suddenly went down. Okay, for whatever reasons and everything immaterial, but it suddenly went down. And you will find when our market closed, the price was high. I'm holding a few futures of natural gas. I'm happy, and next day directly down. It opened with a huge gap. So these things can happen in the overnight situations. We have to be careful about that. The main problem with future to option conversion is all out of the money options are considered worthless. So even your option is 5 paisa higher than today's close, it becomes zero directly. Okay, because only in the money options are getting converted into futures, long or short position, depending on how you are. So if the contract is in the money, you have to keep the margin available, failing which it can be cash settled, but the settlement charges are very high. So your profits may be less. Even if it is 5 paisa in the money, it will be cash settled, and you will be paying much more than those 5 paisa. You will get 5 paisa and you will be paying hundreds of rupees for that or thousands in that, depending on which contract you are. Okay, so that is the problem with conversion from option to future. Now, if you really want to learn more about the practical training, most of you have already joined my angel broking trading group. Others, I'm posting a link here in the chat box. Just click on it, open your account, and send me your account opening details. We have a special group, especially those who are not my regular students. We have a special group on angel broking for my students, where brokerages are 20 rupees per order. Margins are slightly lower. Okay, and of course, it's a free account. No money to be paid to open the account. Delivery is totally free. Delivery-based stock buying or whatever is totally zero brokerage. You can just click on this link, open an account, send me the details. I'll add you to the group where I'll be giving the guidance about commodity trading, currency trading, what trades I am taking, I share with my students. So you can learn from it. You can use this link. I'll also post this link on the Telegram group, but you can just click here also, and you can start the process of opening the account. Okay. So basically, that is about commodity trading. There will be no charges for the guidance. You have to just be there. Okay. So for now, that is all about the commodity trading. Any questions in commodity trading before we move on to currency? Any doubts? You can type or you can ask questions. Directly, you can unmute, ask question, and mute yourself.
Good morning, sir.
Yeah.
Whether a separate account is to be opened for MCX?
No, not with angel broking. You open that account, everything will be open. Of course, say for future option, you have to give a statement for 6 months and all. Whatever are SEBI rules, those you have to follow, but no separate account is required. with Angel.
Thank you, sir.
Okay. How much margin? Manoj, I already told you, commodity doesn't give you advantage of strategies. So if you're selling an option, margin is same as how much future is required. Okay. So butterfly, you are going to sell one lot, one put, one lot call, one lot put. So accordingly, the margin will be required. There is no lowered margin in MCX. Not so far. They will have to introduce sooner or later, but not so far. So in commodity trading, is all options are monthly expiry or no? There is no weekly expiry for commodity as of now. Okay. Gold or mini, they are about to start, but so far there is no enough liquidity. So at present, there are only monthly options with liquidity. Okay. Any other question? Any other doubt to anyone? You can actually start taking small trades in, say, gold options or something, gold mini options. Low investment, low risk. You buy first and sell later. Don't sell gold options first. And those who are on Angel Broking Group already, soon I'll be starting this guidance on Angel Broking about gold also, gold, silver, and maybe crude oil. Can you please repeat most liquid commodities again? Shrikant, this video I'll be loading on my YouTube channel. And I'll be sending a link on your group. Okay. So we'll see over there. You can have a look. For a few days, it will be there. Will delta, gamma, theta? Yeah, they are applicable. They are applicable to all options. Okay. Natural gas has good liquidity usually. At the money options. Don't go for out of the money. Okay. Any other question? Shrikant, because you asked, I'll just go for liquidity thing. You can just have a look at this. Okay. These are all option contracts. So less than 10 lots for copper and silver with in between 1,000 prices. 1,000 price, that is 60,000, 61,000, 62,000. They have better liquidity. In between the thousands, 100, 100, 100. So 60,100, 60,200. They have less liquidity. Again, 60,500 is slightly more than others. Okay. Now, gold, 10 to 100 lots are traded for in between 1,000. When I say gold, it is 1 kilo gold. All right. Silver, round figures, thousands. You get 10 to 100 lots per day. Natural gas, in between. So it is not in thousands, it is in tens, 10 rupees. Okay. So they have 10, those lots have 10 to 100 lots liquidity per day. If you talk of gold ending with 1,000, 50,000, 51,000, 52,000, 100 to 1,000 contracts are traded every day. Gold meaning even in between thousands, they are having 100 to 1,000 lots traded every day. Natural gas, round figures, like 400, 450. There you will find up to 1,000 lots traded every day. Options. And more than 10,000 lots per day are crude oil and gold mini, which are round figures, thousands. So fantastic liquidity over here. Something like a few hundred contracts every hour as an average. 15 hours, 10,000 divided by 15. Something like still 600, 700 lots every hour or 10 lots every minute approximately. Okay, so they are having fantastic liquidity. So any other question? So natural gas also we have seen the liquidity. Okay. If you don't have any questions, we'll move on to currency.